Good morning. Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, July 29th, 2021. It's the day after a Fed day, and while yesterday really was among the more lackluster of days, today we're off to a much better start. I think the reason for that, quite frankly, has nothing to do with the Fed. They really didn't say much yesterday. Yes, they could bring their target date forward in terms of tapering, but we're still talking months, if not years away. The chairman was evasive when he needed to be, and left something in there to keep the current narrative where it is, and markets are pretty comfortable with the status quo since we are again at all-time highs. The reason I think today is because of the infrastructure bill that made it through the Senate. There's still a long ways to go, but remember, infrastructure falls on the side of fiscal stimulus, and so even if the monetary stimulus news was uneventful, mediocre, I think the markets can take some pride in the idea that there's infrastructure coming, and we're seeing today a bit of an outperformance in the Russell 2000, which are the economically most sensitive stocks. That kind of bodes to the idea that fiscal measures are good for the smaller companies, the economically sensitive companies, et cetera, and off we go. Among the most actively traded stocks on the platform, however, have nothing to do with the U.S. economy. They're basically Chinese stocks, and we're seeing tremendous activity. And I guess one of the things that I wanted to bring up is just I think what's been going on in China has been fascinating, and if you haven't been following what I've been writing about it, there are plenty of places to look for it on the Traders Insight page because it's been a topic of mine pretty much since the Didi news first broke. I kind of put aside the Alibaba story when they were sort of harassing Jack Ma, and I took that more or less to mean that they were trying to keep that Beijing was really not happy with what Jack Ma was doing specifically, and that their moves were more or less to keep him in line. Then when they discussed taking Didi off app stores, that made it a bit different because it wasn't just one company. The question became, were they punishing financial success? Were they trying to get a handle on data? I'm convinced it's the latter. But the most recent stories about basically trying to nationalize private education stocks were certainly not taken well by the market. The Chinese government realizing that only after there were broad sell-offs throughout China, because I think people ratcheted up their risk assessment toward investing in China, which is, again, a theme we discussed before this became a major problem, when it seemed more company-specific. So last night, what did they do? They called in, the prior evening, our time, they called in what I'm going to call the Chinese plunge protection team. They got the banks on the phone, they got international banks on the phone, they rallied support for the market. Now, mind you, the CSI 300, it wasn't as though it was in a death spiral here. It had just fallen sharply, but I think they felt that they wanted to shore up the investment climate, that they more or less, as a result of what was more or less self-inflicted harm. And I think that what we're seeing is a bit of a retrenchment here. I think that the ultimate goals of the Chinese government, first and foremost, are always stability. But I think it's also, there is a control over the data aspect of it and control over the situation. Those two don't always go hand in hand, particularly if you're a foreign investor. And I still stand by my idea that there is an added risk to investing in Chinese companies because the government of China has their own motives, and those motives do not include you as a foreign investor. Now, they did yesterday because they wanted to shore up the investment climate, and that involved all investors, foreign and domestic. But I do think that this ratchets up the risk. The other thing that I have to bring attention to is what I'm going to call the Pavlovian response. And I think that As of now, this is something that has been really working for investors and traders alike. Going forward, let's have to question whether it's sustainable. And that Pavlovian response is, if you see a dip, buy it. This is, by the way, not investment advice. That's just acknowledging what the response is. Because one day there's a dip that overwhelms you, and markets can remain irrational longer than you can remain solvent. But bottom line is dips are shorter, shallower, and people are just using that as an opportunity to jump in and invest. And I will say, it's worked. It's really hard to tell people to be cautious about a strategy that works really well. And the message that investors have gotten, particularly over the past year and a half, is the government, whether it's the central bank, whether it's the fiscal authorities, no matter where it comes from, they have your back. And so dips are getting shorter and shallower, which ultimately, argues the question: how short and shallow do they become? Do you ever get buying opportunities? Again, if you take it to the logical extreme, and every dip is bought as soon as it becomes a dip, then you never get dips. And we all know that that's really an unsustainable situation. As of now, I think investors have learned a lesson that has worked really well for them. But remember, Pavlovian response does not require intelligence. It's reflex. It's basically a learned behavior that becomes reflexive. And that, I guess, is the thing to take away. If you do see a dip and buy one, again, that strategy's worked. And as a trader, that's been largely what I did for most of my life. But you have to sometimes get a sense of when the dip is going to be a buying opportunity, and sometimes those dips are not. As of now, in the last year and a half, there hasn't been a dip that hasn't been a buying opportunity. But again, we don't want to have to unlearn a behavior that's worked. So bear it in mind. I'm not telling you not to buy dips. I'm not telling you not to trade. Obviously, a lot of our customers have been trading Chinese stocks dramatically. We see the volumes exploding within our system, and of course throughout the industry. And this is the sort of thing that has worked. And again, depending on when you bought, it worked for you again. Other people may say, all right, this little rally we've had in the Chinese shares off the lows is an opportunity to lighten up positions if you're concerned about the risks of owning shares in China for the reasons we outlined earlier in the call. And I will remind you, if you're trying to sell, it's a lot easier to sell into a rally than it is to sell into a decline. But as of now, the Pavlovian response for traders worked once again. It worked in the U.S. Last week when we had basically a 2-day drop that disappeared very quickly, and in China, where the drop hasn't necessarily been erased yet, but definitely presented some opportunities for traders. Anyway, have a good one, everybody. We will talk soon. Bye-bye.